Hello, investors. It's Don Vandenbord, Chief Investment Officer with Revere Asset Management. Today is Wednesday, April 24th, 4:54 p.m. Eastern Time, coming to you from the financial capital of the South, St. Augustine Beach, Florida, with tonight's Revere Roundup Daily Market Insight video. State of the market, we're in a mild correction, meaning we're 4 or 5% off of the highs of the S&P 500. Check the trend gauge in the upper right. Leaders showing the red arrow. Don't like red arrows. We like green arrows, but we've got a red arrow. Yellow sub arrow. Meta's not helping that after hours. We'll talk about that in a minute. And then we invest across 3 time frames. So we monitor the health of the 5 major indexes across the short-term 21-day, medium-term 50-day, and long-term 200-day moving average. 4 of the 5 major indexes are below the 21-day moving average, which is declining. The Dow closed right on the 21-day for the second day in a row. Medium term, all 5 below the 50-day moving average. Long term, all 5 above the 200-day moving average. Remember, the market never gets into serious trouble unless you get down to and break the 200-day moving average. Normally, it's about a 10% pullback from the top until you hit the 200-day moving average, and those are fairly frequent in the market. So it's a matter of understanding when the wind is at your back and when the wind is at your face. And we reduce exposure when we start breaking moving averages. And it's pretty easy to track what we're thinking just by looking at these arrows. So what happened today? Attempted rally day 3 off the bottom, as you know, following the O'Neill methodology. You look for a follow-through day on day 4 through 7 off of a low. And day 3 mixed, very typical after a fairly strong 2 straight days. We ran into some overhead resistance on a gap up and pulled back from there. Closed off the lows, but certainly off the highs too. So we'll call it a mixed day, as you can tell by the rainbow in this little chart here. But after hours, Meta is getting hit pretty hard, down about 12%. And that's going to trickle over into some other tech names tomorrow. So we'll be swimming upstream from the get-go unless something significant happens during the conference call. One of the headlines that I did read was that one of the reasons why they're down is because of increased spending, but increased spending it means CapEx spending, and that's good for some other AI tech leaders. So we'll see how that plays out tomorrow. Here are the final numbers. Our 21 over 21 leaders list, just barely positive on the day, up 0.10%. 10 positive, 4 neutral, 7 down. When you see 4 neutral, that if something is up or down less than 0.1%, we consider that basically neutral. The big 7 down 1%. We don't include Tesla in our big 7. Tesla was up 12% on some promises that Elon made after a terrible quarter, primarily tied to a low-cost vehicle that is supposed to come out early next year. We'll see how that plays out. He's made quite a few promises before that haven't always delivered, but you can't fault the guy for what he's accomplished in his life. But the big 7 down, Amazon down 1.6% and Netflix down 3.9%. That continues to get hit after its earnings report. RG8 basically flat. This is our 8 growth ETF composite. S&P 500 gapped up 0.33%. NASDAQ 100 gapped up 0.8%. S&P finished basically flat, equal weight, a little bit better. NASDAQ 100 pulled back from that gap up, still closed up 0.34%. But as I said, giving that back after hours, equal weight up 0.4%. Dow down 0.1%. Mid caps up 0.05. Russell 2000 small caps down 0.36. Global diversified 60/40 stock bond down 0.17. GROTECTION, our flagship portfolio, down approximately 0.19%. We'll get to the portfolio and some charts. First, we hit our inter-asset correlation and index charts as we always start off. So you can see the bounce off this purple line so far, which is the 100-day moving average, and then day 3 up, getting close to that declining 21-day moving average. Let's look at it on a 5-minute chart. You can see the gap up here sideways for about 45 minutes before breaking and giving it up. A little bit of a rally in the afternoon, a little bit of a swoon later in the afternoon, a little bit of a rally late afternoon, and then sideways into the close. Uh, we've got 2 more big tech names reporting tomorrow after hours that'll have definitely have some say with how the rest of this week plays out. But right now, on a third day up, you really don't want to buy into day 3 strength if you've been waiting, especially in a market like this. Getting back up near the top of the range, it's better to try early at support levels similar to this 100-day moving average, and then possibly look to sell into strength. It's a very complex decision tree when you get to a bounce after a sell-off. And this is why we really rely more heavily on the broad S&P 500 at this point, while the market chops around and leadership takes various forms, and the fact that we're in earnings season. All those things factor into what we do. NASDAQ 100, second close above the 100-day moving average, but closing in bottom third of the daily range as it approached this declining 21-day moving average. Dow Jones Industrial Average, right on that basically flat 21-day moving average. Mid caps, let's look at the chart of the mid cap 400. That ran into the declining 21 and closed basically unchanged. And Russell 2000 ran in yesterday to the declining 21, didn't get as high today, but down 0.36% on the day. So that's the 5 major indexes. Let's go now to the VIX. VIX, tighter range today, as we had a somewhat of a tighter range in the market, below the 21-day moving average, hanging right around that 16 level. US dollar, not much action today, kind of a tight range, up 0.14%. Precious metals, gold down, still above the 21-day moving average. Gold stocks, GDX, slightly positive on the day, hanging above the 21. Silver SLV down a bit, also hanging near the 21. Bitcoin weak today, breaking back below. No, I did it again. I showed BITO. IBIT is what we want to look at. Breaking below the 21-day moving average, sitting on the 50-day moving average. Now to bonds, BND, tight range today. For the most part, bonds down, meaning yields ticking higher, but look how tight of a range we've had for the last 6 sessions. So coiling for a move one way or the other. The PCE inflation data that comes out Friday before the open might have something to say about which way this breaks. Long bond TLT closed at the top of the range, still down 0.71%. So kind of an undercut of the recent low, and back near the support level. PYX, the 30-year bond yield, up 1.29%. 10-year yield TNX up 1.17%, also in a tight range there. So that's our inter-asset correlation. Let's go to the tail of the tape. I mentioned the PCE inflation data on Friday. Day count from up to with the consolidation day today. Back above the, I don't know, I don't have the ADMA on the chart. It's either back to 0 or a +1. I think it's a +2 now, actually, on the 8. 21-day moving average, this would be the 9th day down. Negative expectations while we're below there, certainly tempering our enthusiasm, as you might say. Sectors to the upside: semiconductors, tech, XLY, that's consumer discretionary, mostly because of Tesla. XLP, staples, and regional banks. To the downside: transports, home builders, oil services, industrials, retail, and biotech. Two tiny buys in the portfolio, CEG and VRT. VRT initially gapped up on its earnings report, gave up quite a bit. We bought some after the gap down. CEG, we bought in the morning. It pulled back a bit after that. Both of them are tied to the data center infrastructure play. VRT, we've been shaken out of that in the past with a low risk entry, giving it another shot, slightly raising our exposure from 0.48 to 0.52. Bottom line on the day, attempted rally day 3 closes mixed. Leaders also mixed. Meta earnings report reaction hitting tech after hours. Okay, let's take a look at some individual charts. We'll start off with what we bought today, CEG. This is on the 21 over 21 list. Actually, no, it's not. It regained the 21. It was not on the 21-21 list. It closed right below it on Friday, but we've been noticing the relative strength and we're aware of the story. And strength in the morning, pulled back, still held the 21-day moving average. Other buy, VRT. Big gap up, was sold, came down and started to bounce. We got into this around 84, so a slight gain on this as well. The other recent buys not doing so well, Spotify. And again, we size these exceptionally low, small in order to handle the volatility and the questionable market. Breaking below the 21-day moving average. If you look at a weekly chart, it's just a pullback to the 50-day, and that's what we had into, or the 10-week, and that's what we had in consideration when we take small entries in a market like this. They're more, it's really just low risk entries, hoping looking for, and I know hope isn't, why would I say hoping, right? Like hoping, like hope is an investment approach. No, but we've got a list of good names, good stories. Look for low risk entries that we can weather the storm. We don't completely sit on our hands. We look for opportunities. They don't always play out, but if they do, they're tiny losses to the portfolio. In fact, these 4 names that we've bought now with the mixed is down 0.10% of the overall portfolio. So that risk is skewed to the upside, you might say. And First Solar, initial strength in the morning, still in this consolidation zone. We're down a couple of percent on this as well. Let's look at a couple of other standouts on the day. Dexcom up 3%, regaining the 21-day moving average. They've got earnings tomorrow, though, so that obviously will bring some volatility into the picture. Coin down, which is very, I mean, it moves. Coinbase moves in sync with Bitcoin, so regaining the 21 yesterday, losing it and sitting back on the 50-day moving average today. SE, a 21-21 member, looking pretty good, continuing to make higher highs. Oh, FCX, Popper, struggling, excuse me, a little bit recently, but closed at the bottom of the, or near the top of the range, right on the 21-day moving average after reporting earnings yesterday and being down a bit. So this is a pretty good look for copper. Watched pieces of an interview with the CEO, and he said he'd never been more bullish on the industry. VRT we talked about. How about some other data center related names? SMCI, extremely volatile. We got stopped on this last week. Bounced at the 100-day. Needs to form a new base. Dell, another data center stock. A lot of these gapped up and pulled back, very similar to what VRT did today, but pulled back still above the 21-day moving average. NVIDIA got into some overhead resistance, namely that declining 21-day moving average, and reversed on the day. And it's down another 1.5% after hours, it looks like. So we'll see how this finishes tomorrow. We still have this hedged in taxable accounts with the NVD ETF, which is a single stock ETF. That's going to wrap it. As always, like to hear from you. The email is don@revereasset.com. The phone's 855-REAL-WEALTH. That's 855-732-5932. What we're looking for tomorrow is to see the overall reaction to Meta earnings. And then after hours, pretty sure it's Google and Microsoft tomorrow after hours, so that should have quite an impact to things overall. Playing things tight right now uh, with us between the 50-day and the 100-day moving average, the 100-day acting as support, the 50 and the declining 21 acting as resistance. So taking extremely small position sizes at favorable entry points to be able to ride out some volatility and get into potential leaders should the market decide to right itself and rally. And tomorrow is day 4 of the rally. So that opens that window, that O'Neill window, looking for a follow through day. A lot of people sticking the proverbial stake in the heart of this market, saying this rally is over. Strong bull markets like this don't typically end this quickly. It's typical to have a pullback like this to the 20-week/100-day moving average. Could get a little bit deeper if it broke the 20-week/100-day moving average. Let's look at the weekly chart here. You can see we're sitting on this green line. Look at during this rally during 2021, how many times this green line, or between the red line and the green line, which is the 10-week and the 20-week, or the 50-day and the 100-day, it's touched quite a bit. And as long as it's trending higher and providing support, and you get back into the range and then make an attempt at a new high, and that's kind of what the market is doing right now after a very nice rally off of the November lows. But if things get worse, we'll get more defensive. It's that simple. You saw the pullback here, over 10% from 46.07 to 41.03, and how moving averages broke during that process. But the 20-week just flattened out while we were underneath it, but now providing support. So you also could see a situation like this play out where the initial leg one down during last fall's pullback, late summer, early fall pullback, held the 20-week, recaptured the 10-week, and then rolled over again, which resulted in a 3 waves down situation, which you can see here. That's certainly not out of the picture. And then that would set up a late year rally. Typical seasonality would come into play at that point. We've got sell in May and go away coming into the process, which is the years. There's a lot of research we've been doing on the Trader's Almanac about what's typical for different not only times of the year, but also during election years. And it's usually strong late April, pulls back a bit in May, and then generally strong into the election. But those aren't decision-making points. Those are secondary indicators, and we'll see how they impact things or don't impact them, because there are a lot of obviously cross currents going on with the market between wars, rates, QT. Is the recession finally going to happen? Is inflation under control? What's going to happen with Russia, Ukraine, and the Middle East? Whole lot going on here, but the market climbs the wall of worry, and it certainly did from November through the end of March. And now we're just correcting off of that. And if you are interested in an approach like this, GROTECTION is our flagship portfolio designed to grow assets during uptrends, protect them during downtrends. Right now we're in kind of in sideways mode with the market. We pull back our exposure when we're under the 50-day moving average to about half of what the S&P 500 risk would be. See how things play out there. If we get back below the 100-day moving average, we pull back a little bit more. Under the 200-day moving average, all bets are off. If you like this approach, you can email me, don@revereasset.com. If you're interested in becoming a client, my partner's Dan Stewart, dan@revereasset.com. Phone's 855-REAL-WEALTH. That's 855-732-5932. And with that, I'll wrap up the video for Wednesday, April 24th. This is Don Vandenbord with Revere Asset Management, telling it like it is. Thanks for listening, and have a great day.